Hello and welcome to another one of my videos, and today I'm going to be talking about stocks versus bonds and how are they similar and how are they different. So first off, a stock is buying ownership in a company. So for this example, let's say I have a lemonade stand and I'm willing to offer you 5% of my lemonade stand. So you can buy that 5% and that is stock. So if my lemonade stand does well, then you will get more money. And if my lemonade stand does bad, then you will lose money. And then the next option is the bond. And bond is debt. So for my example, let's say you give me a loan for my lemonade stand and I agree to pay you 5% interest on that loan. So I have to give you that 5% interest on that loan, even if my lemonade stand's doing bad. So if my lemonade stand's doing great, and I think I'm pretty smart and I can really sling some lemonade to the customers. So if my lemonade stand has gone up 10%, then the people who bought the stock are going to be doing great. And the people who bought the bond, I mean, they're going to make the 4 or 5% that I agreed to, but they're not going to get any of the extra that I'm doing because I'm doing well. However, let's say I suck at selling lemonade. I mean, I sold lemonade, I left like 10 seeds in each cup, and then one day I forgot sugar and I put flour in all the lemonade. So nobody wants to buy lemonade from me anymore. Then the stockholder would be doing really bad because I'm not selling any lemonade anymore and the company's value's gone down. But the bond guy, he's still getting the exact same amount of money, so he's still happy with it. Now let's say I put too much flour in lemonade, I left too many seeds in it, and I have to shut down my lemonade stand because nobody's buying from me. So then I have the money I have and I sell all of my equipment, and all the money I get from selling everything I first give to the bondholders because it's my debt. So the stock person only gets money if I have money left over after I paid off all my debts. I think that was a pretty good explanation, but I'll go a little bit more in depth now. People like stocks because it has the chance to grow an unlimited amount almost. It's not unreasonable for a company to go up 20% in a year. However, if you have a bond of the company, you're locked in at that 4 or 5%. The reason people buy bonds is because they want less risk. So a lot of people buy more bonds the older they get. So you'll see a lot of people who are like retired have almost all bonds because they have their money and they just want to keep it. However, if you see a lot of young people like me, I have no bonds, I have all stock because I want the potential for a lot of growth. And I'm willing to risk losing value in the short term for it to go up in the long term. There are a few types of bonds. There are government bonds, which are from the federal government, like the big government. There are municipal bonds, which are from more like local government, like your city or whatever. Another type of bond is a corporate bond. So this is kind of what I think everyone would think of when they think of a bond. And this is when you buy a bond from a company. So it's like buying a bond from Walmart. You're like, hey, Walmart, I'll give you $1,000. Give me 5% of my money back every year for 20 years, and then give me my $1,000 back. Then there is a risky section for each stocks and bonds. So for stocks, they're called penny stocks, and they're very small stocks and smaller companies, and it's very risky. It's common for these companies to go all the way down to zero and for you to have lost all your money. And then occasionally they explode and they do well. There are also bonds called junk bonds. These are bonds from companies and governments that have bad credit and they have a greater likelihood of defaulting. And the upside of this is they'll give you a higher interest rate, and the downside is that they might go out of business. So you won't get all of your money back. There's also a type of bond called a zero coupon bond or a accrual bond. And this is a bond where they don't pay yearly interest. Instead, the interest builds up and they pay off all the interest when they give you the money from the bond back. So let's say it's 10 years, $1,000 loan with 5% interest. They're not going to give you any interest until the end, and then at year 10, they're going to give you the $1,000 back plus the 10 years of 5% interest back, so you'll get $1,500 at the end. So when looking at the statistics for how stocks and bonds have done, since 1928, the historical return for stocks is 8 to 10% per year, and the historical return for bonds is 4 to 6%. And then in the past 30 years, stocks have averaged an 11% return and bonds have averaged about 5.5% return. So you have to decide, am I willing to put in the risk in stocks for about double the growth? And for me, the answer is yes. So you might think, hey, I want to be safe. How do I buy bonds? And you can buy a lot of bond ETFs within most of the brokers that you use, such as Fidelity. So I kind of look at 3 ETFs for bonds that I found. The first is Fidelity Total Bond ETF with the code of FBND. And this is a pretty safe bond. It has a 2.7% yield, which means like how much money you get back. And it has about $2.5 billion of bonds that it holds. This is a safer bond ETF. So if you really want to make sure your money will just steadily grow about 3%, this is a good option for you. Another option I found is this iShares TIPS bond ETF with the name of TIP. And this is a interesting one because it keeps up with inflation for the most part. So right now the yield is about 8%. So that's because inflation is about that. However, if inflation went down to 1%, the growth rate on this would drop down to 1% as well. If you think that inflation is going to keep on going up for the next year or so, then this would be a good bond to put your money into. So this is for if you want a bond with as much risk as possible, pretty much. So the current yield is 7%. The reason it's so high is that it owns a lot of riskier bonds, such as bonds that are in developing countries like Brazil and Mexico. They also have bonds that are at a lower credit rating than the first two would have it in. So this is overall riskier, but the rate of return is much higher. So in recap, a bond is owning a portion essentially of a loan from a company, and a stock is owning a small portion of the company itself. So the bond will have a more guaranteed return, and the stock will have more risk, but also has the chance to go much higher. For the most part, I would advise getting stocks instead of bonds, specifically the S&P 500 ETF that I've been advising. However, if I were to buy a bond right now, I would get the iShares TIPS bond ETF, because with the code of TIP, because this bond is staying about with inflation, and I think inflation will remain high over the next year or so. Thanks for watching my video. If you have any questions, please leave it in the comment section. Please like and subscribe, and I'll see you later.